If you look at the U.S. Treasury notes, yielding 4.4%, implied in that there is a real rate in the above 2%, between 2 and 2.25%. I think that's a pretty healthy real rate that investors can earn on a U.S. Treasury note, especially if you take the view, like us at Pimco, that the neutral rate, that the equilibrium rates in the economy have not changed substantially over the past few years. And we think equilibrium rates in the U.S. remain pretty low in the 0 to 1% area. Now, in the near term, there is a decent amount of rate cuts priced in already for central banks, like for the Fed, almost 100 basis points for next year, similar for the ECB. So I wouldn't bet necessarily on more cuts than what's priced in the market. But if I look at the curve as a whole, I think there's still value in duration.
Well, will you say that the market's not pricing in enough recession expectations? So does 100 basis points of cuts reflect a recession in that case?
No, I think the market is pricing what you could call an immaculate disinflation scenario, where growth remains pretty solid and inflation falls nevertheless to target. We would take a different view. I mean, we think that what has been supporting growth is a fiscal sugar rush, which looks set to fade. And we also think the impact of monetary tightening will accumulate and will be felt in 2024. So I think if you look at risk assets, be it equity markets or credit spreads, I think they are signaling a pretty benign economic outlook, and we would probably be more cautious than that.
Okay, so that makes sense. And you would be more cautious on some of that riskier outlook. But can you kind of define what type of downturn you're exactly looking for? Because we've kind of lost the meaning of soft landing, hard landing, no landing. Honestly, Nicola, none of it makes any sense anymore. What exactly are you expecting for 2024?
So for 2024, I mean, we expect a sort of mild recession type environment between stagnation and mild recession. So a U.S. economy that has been growing at a very healthy pace, shifting down towards 0% or slightly negative growth as we go into 2024. Now, that's not a deep recession, but it is still a recessionary type environment. I mean, remember that whenever the unemployment rate rose on a sustained basis by more than half a percentage point in the past, the so-called SAM rule would, suggests that at that point, normally a recession has been called by the NBER. So that, we think the unemployment rate will rise from here, and that will be a recessionary type environment.